We're here with Tatiana for this week's Mortgage Minute. And what you got to say?
Well, I've got to ask, number one, what's going on this week with interest rates and the mortgage market? And then at the end, I want to reserve some time because I want to talk to Tatiana about buy downs.
Okay. Yeah, so what's going on with the interest rates this week?
Hi, guys. Well, first of all, thank you so much for inviting me to this Mortgage Minutes. I love it. So interest rates. They went up again. They continue increasing. And, the good question is, when we're going to finally get some relief from the sky-high mortgage rates?
Right.
Probably not until late next year. And, but we might start seeing some rates inch down in the coming weeks and months, depending on certain key economic indicators. For example, yesterday's ADP numbers showed 89,000 jobs created. It's significantly lower than 180,000 in August and 160,000 forecasted for September. So that is the sign of the economic slowdown. And when inflation comes down, the mortgage rates come down.
Okay.
So, the Fed has indicated that it is watching for sustained signs of slowing of inflation, and it's not going to lower the rates again anytime soon. So that's
not going to lower or raise. Either one. Are they just going to kind of hold steady for a while? Is that what they're thinking?
Yes, that's what they're thinking to do. That's what they're gonna do. And Fannie Mae and Mortgage Bankers Association predict that mortgage rates will fall next year, but they disagree about the fourth quarter of 2023, as some other companies predicting. So they think that rates are gonna start going down first and second quarter of 2024.
Okay, so the beginning of next year, then,
yeah, that's kind of what I've been hearing.
Okay.
Is kind of like beginning of 2024 to spring of 2024.
Mm-hmm.
The way they expect to take something down. Okay.
Okay, but then it still bears repeating, I think, every single time we talk, that it still doesn't make much sense for people who are ready to get into a new home now to wait when they can just refinance once those rates are lower, right?
Yeah,
because
yeah.
Everybody who's waiting, then they're going to flood the market, and we don't have the inventory for everyone to be shopping at once, because then the prices are going to go even higher than they are, right? So even if the rates are going to be going down, we still don't need to hold off, right?
Exactly. And, those are all predictions. And a lot of times all those, specialists, they prove to be wrong a lot of times. So we don't know how is it really going to go down, the rates, going to go down in beginning of next year or middle of next year. And just like you said, people wait, a lot of people are waiting. And, once rates go down, prices are going to go up.
Right.
More. There's going to be more competition. Yeah, rates will go down, but you're going to end up with the same monthly payment because price increased.
Right.
We actually did a case study where we looked at buying now with a higher interest rate versus waiting for a year for the interest rates to be lower and buying then, and how it actually cost in that one example of a $500,000 house. It actually cost in the case study like $35,000 extra to wait, even with the extra payments calculated in, even with the all of the factors calculated in with the higher interest rate versus the lower rate, because of that price escalation when the demand hits the market. Exactly. So, and if I can do it, I'll somehow link that to this video in some way, shape, or form.
Yeah, because I know you see that a lot, Tatiana. We've had that discussion about borrowers, and you've gone into the cost of waiting with them, and it oftentimes works out that way, where they're losing money by waiting.
Yep.
Exactly. And yeah, I saw your video. It's great, and I 100% agree with all the numbers and everything you say.
Okay, so I'll make sure link that. So what did the rates go to? Because last week they were at 7.31. What did they go to this
week? So they're about 7.5. That's with 1 point. Remember that it's always with 1 point. I see now 7.75 is 0 points.
Okay.
A lot of times, of course, it all depends on everybody's situation and credit score and how much they put down, what program they do. It. Government
property,
programs tends to be having lower interest rate than conventional. Right now, we're talking about, Fannie Freddie, that's conventional rate.
Yeah. Okay. Okay. All right.
Okay, so we've been talking the last several weeks about ways that people can kind of mitigate these higher interest rates, right? That we're all starting to get used to. We talked about discount points and we talked about ARMs last week. And this week, would you please go into buy downs with us?
Mm-hmm.
Okay.
Yeah, so the buy downs could be a really good temporary solution, right? For clients that maybe not want to buy now, but they're not too comfortable with monthly payments, and they're betting on refinancing later. Temporary buy down could be a good solution. Created little PowerPoint again, because I think visual is really good. Let me share my screen.
All right.
Let me figure out.
Oh, we have the lawn people here again. Just that they showed up right as we were launching.
Oh, really?
I said it's time to set up. That means they're going to be pulling up any minute.
Yep, and they did.
But we're not even going to pause, right?
No, we're not pausing. We're
Yeah, that's okay, because I can't even hear them.
Okay.
Okay, so let's see. Can you see my screen? And it's empty right now, right?
Yes.
Yes.
Okay, so temporary buy down. How does it work? So 2-1 buy down. 2-1 buy down is when the interest rate lower by 2% the first year, then it's lower by 1% next year, and then goes to initial interest rate. So I'll go into details in a second. So let's just look at this scenario. Purchase price is, let's say, $630,000, 20% down payment. So the loan amount is $504,000.
Okay.
And the interest rate is 7.5%. APR 7.677, because APR is always slightly higher than interest rate, because it factors in some of the closing costs.
Okay.
Yeah.
So the principal and interest payment, the very first year, the interest rate will be 2 points lower than 7.5% than the initial rate. So it will be 5.5%.
Okay.
And principal and interest payment in this scenario is $2,862.
Okay.
The second year, the interest rate is reduced by only 1%, so it's 6.5%, and the payment goes up to $3,186.
Okay.
And then years 3 to the remaining 30 years, unless we refinance, right? The rate is 7.5%. And principal and interest payment is $3,524.
Okay.
And it stays like that for the remainder of the life of the loan, right?
For the remainder, exactly.
Okay.
And so in this scenario, buyer savings over 2 years is $12,010.
Wow. Okay.
So in this type of buy down, actually it's being paid by the seller. It needs to be paid by the seller.
The seller
so
has to
ask
pay
seller
it.
to contribute.
Yeah.
And which you're gonna be the judges, right? As realtors, it's gonna be possible for every scenario, for every contract. Maybe not. Maybe we can look into different type of buy down. There's also 1-0 buy down. Is not paid. It doesn't have to be paid by the seller. It's paid by the lender actually. And the way that works, I didn't do scenario for that one, but it's pretty much, it's similar. So the rate is lowered by 1% the first year. So instead of 7.5%, it will be 6.5%. And then the second year, it would go up to the full 7.5%.
Okay. And that's paid by the lender?
I'm sorry. Yeah, that one is paid by the lender. Exactly.
Okay. So that's kind of something that's like a promotion that a lender might offer. Is that what I'm hearing? Okay.
Exactly.
Okay.
Okay.
So this is just little disclaimer that I have to put in the video. Somebody wants to read, they can pause and read, but I'm gonna stop sharing.
All right, Kel, read it to them.
Yada 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 blah blah blah.
All right. Okay, so to summarize, and correct me on any of this if I'm wrong, because there probably will be items. So 3 strategies for mitigating the higher interest rates. A permanent strategy would be discount points, paying points down, and then you're buying a lower rate for the whole time. The next 2 strategies were temporary strategies. The first one being an ARM.
The adjustable rate mortgage.
Yep, and then we talked about those last week, and then this week are discount points.
Nope,
No, this week
buy-
are
downs.
buy downs,
Mhm.
which has to be paid for by the seller. The ARMs have no extra cost related to them, and the buy downs have to be paid for either by the seller or the lender. Is that correct?
1 buy down is paid by the seller, 1 0 buy down is paid by the lender.
Okay, got it.
Okay.
Okay.